All right. Hey, broker community. I am here today with Brian Vieaux. Brian is the president of Finlocker, right?
That's right. That's me.
President of
Hey,
Finlocker,
everybody.
former SVP of TPO at Flagstar Bank, longtime mortgage veteran executive. How are you?
I'm doing well. Thank God it's Friday. There's not a lot of days I say that, but after this week especially, I think we need this weekend.
Well, I see CNBC's on the background. Everything's in the green, so that's probably a good way to end the week for at least some people.
Yeah, I'm glad. I just switched off Nickelodeon. I've been kind of watching cartoons all morning, but yeah, it's nice to see green. I woke up and the first thing I looked at was the futures, and that had a lot of green on it. So hopefully that'll help people out here.
That's the hope. And you're in Michigan. Obviously, there's some new coronavirus situations there, and obviously it's a fluid situation everywhere right now.
Yeah, I think this morning we're up to 12 reported cases in Michigan, which jumped, from 2 on Wednesday evening. So I expect we'll start to kind of see that number rise dramatically. The school systems in the state of Michigan have been shut down till after spring break. That's kind of a new development late in the day yesterday.
Wow.
So yeah.
Yeah, I actually just got off the phone with the head of capital markets for Home Point, and they said that they're in the process of kind of getting everybody to work from home and going through that whole situation.
Yeah, I mean, it's one of those scenarios where, I don't know that you can say you can ever prepare for something like this. You can have contingency plans and your disaster recovery plans, but this is unprecedented. And so, I think thankfully technology has evolved for everybody, every industry, and ours as well, so that a lot of key staff can work from home, still be productive, and hopefully not have too much of an impact to business. But the reality of it is, again, these are unprecedented times. So there is going to be an impact to our business, which means there's going to be an impact to the consumer. Today, we're not an industry that can do everything from an front end electronic process all the way through to closing, right? We don't have 100% e-closing out there. We don't have enough counties, frankly, that can handle that from an infrastructure perspective. So yeah, I've been watching these interviews you've been doing, which have been great. And, I think the message to everybody is there will be an impact. It's not, you can't avoid the impact. It's how you deal with it and how you manage your client relationship. So it's just, to me, it goes back to basic blocking and tackling and just being very realistic with our clients.
You're right. You're 100% right. And I think that the thing that I think that over the last 48 hours I've discovered is that a lot of people are talking about, how they can adjust their business to maintain and manage and go forward. And I was in a couple meetings yesterday where I'm listening. I'm like, okay, you guys are going to have these people work from home. This is what you're going to do to manage your existing business. And I just said to them, I was like, well, every school district in 8 states is closed. How are you going to get a DOE for the next 30 to 45 days from the school districts? So if you have a borrower from one of those school districts, how do you get a VOA?
You can't. It's not going to. It's just not going to happen. Those are the things that are going to slow down.
Those are the things that are going to derail the system. So now, who's communicating that back to the consumer? That's just one example. The state of Massachusetts, their entire recording office for deeds is offline now. So how do you deal with that? I mean, these are really big things. So I think right now people are looking at it saying, hey, this is what I'm going to do in my business, like what we can control. But the things that you can't control are going to be, is a notary going to go to a consumer's home and do a settlement? Probably not.
Happening.
Are appraisers, realistically, I would imagine next, 2 to 3 weeks, we're going to see appraisal turn times with all the capacity in the market. And now with this out there, you're going to see states that go to 30 to 45 days for an appraisal. These are huge things that nobody's really thinking about. I kind of start to, I don't want to be the panic guy, but I also want everybody to be prepared. It's like when this issue gets resolved, rates are going to go up. Okay.
Yeah.
Even if the 10-year treasury stay at, just under 1 and it goes up to 150, that's a big jump. So if you have a consumer that thinks they're going to close on a 30 or 45-day rate lock, but all of a sudden, because of these unintended consequences, they need to get a rate lock extension that takes them further out. Well, guess what? Now they're not getting the beautiful rate they thought they were getting. Like, there's so many things that have to be considered. And my goal is really just to make sure loan originators are prepared and not thinking like, oh, I'm going to lock this deal for 30 days and it's going to be business as usual. Like, think about what's going on around you.
Yeah, I think on the refinance side, that's, and I'm speaking when I say I still have my mind in the mindset of an originator, and 27 years in mortgage origination, so I'm still part of the team. Hopefully, on refinances, our mindset has to be we can control what we can control, and as an originator, it's that upfront engagement with the consumer. It's setting the right expectation, and we've had a run where we've been able to just be phenomenally efficient and provide unbelievable service levels to consumers. And this is something that we can't control. That this impact of it is out of our control. And so all we can control is that upfront process. So instead of saying I can get you done in 15 days or 30 days, we're going to take a 60-day lock and we're going to do our best to get you closed inside of that. Hopefully what's going on here is weeks and not months in terms of this pandemic and what's happening in the U.S. But it's you're not going to be able to get a refinance done inside of 30 days. It's just not realistic. And then flip it over to the other side, the purchase side of the business. Our colleagues on the real estate side that are out there facing off with consumers, buyers and sellers, they have to help us reset expectations at the very, very top of the funnel. Yeah. And 30-day closings can't be the norm. I'm still seeing people on LinkedIn and Facebook, having contracts out there with 30-day escrows, and that's just not a reality right now.
That's right. And I think that's the leading from the front is something that everybody has to understand. Is like the assumption right now, and I've had this conversation with wholesale lenders, is like the assumption is like, okay, we'll handle our business, brokers will handle theirs, but the leadership funnel is to the top. So if you're a wholesale lender, your clients or brokers, they're expecting you to tell them like, hey, what's coming up the pike? Because we don't have an in-house capital markets team. Right. Nobody telling us what's coming. So, that's why interviews like this are so important, because for a lot of brokers, they're not getting this information, at all.
You know what? And I'll just tell you this. I feel for the independent, remote mortgage originator, because that's been me now for the last 7 months. My company's in St. Louis. I'm in the Detroit area in Michigan. I'm used to being in the middle of everything every day in a big corporate office, and I'm disconnected from that, especially on the mortgage side. And so I'm doing what they're doing. I'm calling a lot of people and just trying to keep my finger on the pulse. And but I will say this, that all of these wholesale lenders out there, all these companies are good companies with really good people, and they're all doing everything they can to manage their companies through this process. And at the end, they understand and know that there's two clients in their world on the other end of the transaction. One is the mortgage originator, and then the most important one is the consumer. And there's nobody that's taken their eye off that ball. I can promise you that.
Absolutely, I agree. So what I wanted to talk to you about today is the subject of prepayment speeds and prepayment as a whole, and the impact it's having on really the entire mortgage industry. So I think one of the disconnects that is very common with loan originators, and that includes myself, because that's all I've always been, is this idea that the EPO window, the early payoff window, is sort of the area where there's an issue. Meaning in the first 6 months from the time you fund a loan, as long as you don't pay off the loan, you're not paying a penalty. So the perception with most loan originators is like, as long as I get through 6 months, I'm good. So, I'll start the origination. If there's an opportunity to refinance that client, I'll start the process in month 5 and close it after month 6. But what has happened is there's a whole different set of economics that were never considered when this mindset formed. And right now we're starting to see the real people that are running the industry, the people that set the price that we are able to distribute to consumers, say, hey, listen, these loans are prepaying too fast. So I wanted to ask you, as somebody that's dealt with this at a high degree, what are your thoughts? I mean, like, what is the post 6 month post EPO payoff window look like?
Yeah, so great question. I'll start by saying I am very happy that I'm not dealing with this on a day-to-day basis as I was in my past life. While I miss a lot of the that side of the business, this is one aspect I definitely don't miss, because I'd get beat over the head from our treasury department and our cap markets department and our legal department, and then it's the what runs downhill theory, and then I'd go beat the account executives on the head, and then it came, it ran all the way down to the street level. So there's two pieces that I'll kind of unpack here, because you talked about this, the early payoff penalty provision. There's two economic impacts that I always thought about. There's the economic impact to the originator who's funding a loan through a wholesale lender, or who's selling a loan to a wholesale lender or a correspondent investor. And so there's the contractual obligation around early payoff, right? And so that's typically 180 days, 6-month provision. So that's the economic impact to both the originator and the lender in that scenario. What we always watch, or what I always watched in my past life, not just at my most immediate employer, but before that as well, was trends, and we always looked out for the speeders, and frankly, the speeders that were inside the 6 months were bad, but at least we were kind of being made economically whole in those cases. The worst scenario is when payoffs occurred at day 181 and beyond, and you could see that pretty clearly in the data, who was playing the game and timing things. And so that's for a servicer, for a seller servicer, the worst scenario is when loans begin to pay off on day 181, and forward, because there is no economic recovery. And then we have, our end investors coming down on us as a seller servicer. So it's the agencies, Fannie, Freddie, Ginnie Mae, and they're getting it from their, bond investors and MBS investors. So it truly is a trickle down effect. Yes, there are bad apples, bad actors. Every business has those, and there's definitely people in our business that are, I'll call them serial churners. That's their business model. I always believed there was no longevity in that model, but I've been proven wrong by the market. It's in all of our best interest to weed those people out of the business, because they ultimately hurt everybody, right? If the MBS investors don't like a particular lender's bonds or pools, they're gonna bid those down, and that's gonna impact the ability for that particular lender aggregator to be price competitive. In worse scenarios, and we saw this, as recent as a year ago with Ginnie Mae, what they did with some of the speeds, with some of the large aggregators, they cut them out of the Ginnie 1 securitization pool. That's kind of a very dramatic issue, and I'm not going to be surprised if we don't see that again here in the coming months.
And basically, just to understand, when that happened, so when those lenders were removed from the Ginnie Mae pool, what happened was their price, their ability to be competitively priced on, in that case, VA products or government products, was massively impaired. Like those were lenders that were putting out the best price and the best rates to brokers through their wholesale channels, and within an overnight period of time, they became completely out of the market, priced out of the market.
Yeah.
So what I want everybody to understand is basically Ginnie said to these guys is, hey, listen, your loans, the loans that you do with us that we back, are prepaying at a speed of 3 to 5 times, or it could even be greater, but let's just say 3 to 5 times greater than the average prepayment speed of the rest of the market. And because of that, we have to penalize you in the pricing that we allow you to weaponize or go out in the market with. And because we want to slow down your production, because your production results in faster prepays, which in the end, the investors that make up the market, they're not being made whole. And I think, from a partnership standpoint, what we all have to really look at is, I'm a loan originator, I close a loan, I get paid at the settlement. As long as it doesn't prepay within 6 months, I keep my compensation. Right. If after 6 months it prepays, a lot of people just say it's not my problem. The economics, though, is we're part of an ecosystem, and we're part of, at the end of the day, just one member of the system. If our lenders, Fannie, Freddie, Ginnie, or the investors that backed, MBS and the securities behind these loans are not being made whole or not profitable at the end of the day because the prepayment on these loans is happening so quickly, they're not going to continue to invest.
Yeah. And so, we can point at a few of the, the bad apples that were called out by Ginnie Mae as an industry, but at the end of the day, we were all impacted by it, right? Everyone's pricing's impacted because there's a level of confidence too, that the investing market, kind of looks at. I go back to the very first time you and I talked, Anthony. I think it was like November of 18, if I'm not mistaken.
17.
November of 17. And we talked for quite a while that night. And what I remember talking about was something that I've always thought needed to come back into our business, which is decoupling the SRP, the servicing release premium, from the price of a loan.
Yeah.
And actually having, more of a model that resembles kind of the independent insurance agency model, right? Where you have this SRP, the servicing release premium that you earn the first time you originate a loan and it's sold to an investor. But then you have, it almost becomes a fractional value, right? So I think that's where we get everybody aligned, where you're still, none of us are saying don't do what's right and best for the consumer, but I can't imagine every refinance that's happening at the 7-month or 8-month or 9-month or 4-month mark after origination is truly the best for the consumer. And so, I always thought that having a way to say, you've earned this service release premium, but we're going to pay it out over time, right? And so as long as that loan continues to pay timely, so there's the quality aspect of it, but also pay for a period of time such that the aggregator / servicer is now, has kind of recovered their initial economic investment, everyone's aligned. And when a consumer, is in a position where it is in their best interest to refinance, we want to be able to facilitate that. And we want the broker, the originator, to be able to be part of that transaction, and obviously the servicer. And, I heard Matt on his fast break, I think the other day, talk about this. Is it realistic to think that as an originator, you can earn $8,000 or whatever the number is at origination, and then another X $1,000, inside of X number of months, whatever those months are?
Yeah, I mean, and just, if you think about that, if you really just think about that, just let's just say the average loan amount is $250,000. Okay, so the idea of making the lender pay compensation twice in 12 months. So you're talking about 5,000 here, 5,000 here, 10,000. If you just simply look at that 12-month window, well, if you close the loan in month 1, the first payment isn't going to be due for 60 days or whatever, 45 days. So how many payments are they actually making, the consumer? How much interest is actually being accumulated? And if you factor that over that 12-month period of time, is like outside of the originator, who's winning? And one of the things, one of my first employers, CEO of the first company I worked for, said to me back then when we were talking about the balance between, anytime there's imbalance, meaning loan originator, lender, LO broker, or LO retail lender, anytime the balance between who's making what gets out of whack and somebody's too far up on the other one, they either need to rebalance or they need to part ways because it's not sustainable. And right now, I think the biggest thing is there's been a lack of communication around these things to the origination community. So like me, I had no idea about a lot of these things until really I started talking to people like you and other capital markets people and other people that like really explain the economics of the industry. And then when I would talk to other originators about it, they were like, oh, I get it. And they're receptive to it. But I think for a long period of time, the lending community has kind of just said, we're not going to focus on educating the brokers and the LOs about this stuff.
Right.
But when I look at it today, I'm just wondering, like, when we think about why these things happen, I think the biggest thing is when you're originating a loan for a consumer, a lot of LOs will say, well, I'm always going to do the best thing for them. Well, if you're doing the best thing for them and you're looking at it as a 30-year loan or a 20-year loan, is giving them the highest rate with the lender credit that covers all their costs the best thing for them. Because if you amortize, hey, if I gave them a 0.5 point lower in rate or a 1/4 point lower in rate, and I didn't give them the lender credit, well, the cost is $4,000. And over 30 years, what's the interest difference for savings over the 30 years or versus the $4,000 in cost? Was that lender credit really beneficial by jacking up the rate? Or did you give them a no-cost loan then that set you up for another loan in 6 months? And that's kind of artificially manipulating, giving the consumer the best deal. And a conversation I had with one of the speeders this week was, he said, well, what am I supposed to do? Not do the best thing for the consumer? I said, if you do the best thing for the consumer the first time, maybe with rates going down in 6 months or within 12 months, you'll have a situation where you have to do another loan for them because of, rates going down. But realistically, the people that we're talking about right now, they're not the people that are doing it in those very one-off scenarios. These are people that are doing it 3 to 5 times the average. And it's more of it's a habit and a behavior more than it is a like a one-off scenario.
Yeah, it's whether they want to admit it or not, it's their business model. I mean, I was on the third-party origination side of the mortgage industry for more than 20 years. I've seen every model that's out there, but you can quickly look at a pipeline of customers, right? And I say customers as TPOs, and just look at where they're originating loans at, in terms of in relation to par, and you can predict pretty quickly which ones you're going to have, speed issues with. So to me, it's a business model, and I think there are some systemic things that the industry can do to curtail it, and I think we'll start to see that over time. But I think what you're doing, Anthony, and doing these Zoom meetings and recording it and getting it out there is helping fill a gap around education, because it's not. I don't blame the remote loan originator if they don't have the knowledge, don't have a corporate infrastructure that's going to give them this knowledge, and you're kind of stepping in that role. And I love the fact that you're doing this. I love the fact that you're getting such a wide variety of folks from the industry to kind of talk on this issue. And what's been cool to watch from my perspective is there's pretty much a consistent message and theme, just about from everybody that you've talked to. And so hopefully these sessions are really helping, your audience and your members at AIM. And let's not kid ourselves. You're talking to people beyond your members. And I think it's just a huge value that you're providing to the industry right now.
Yeah, I think there's a couple things that are happening here. Number one, I look at it and I say this. I say the issue that I've really discovered when I would talk to lending executives about all these things is they would educate me on things like prepayment speeds and the way MSR values work. And I'm, as of this week, I've learned so much more just in the last 72 hours than I knew ever before. So like I'm getting that education. But when I go back to them, I'm like, well, why didn't you educate brokers? What the disconnect is pretty bad, because like it's everybody. It's not just like I have had this conversation with everybody from Matt Ishbia to Phil Shoemaker, is like the investment in knowledge needs to start with that internally with their AEs.
Yeah.
And then the AEs need to be the one to interact with brokers and educate them. And I think because everybody for so long has been so focused on originating loans, getting loans in the pipeline, customer service, that bringing up very difficult topics that are not fun to talk about is just it's not something anybody has ever wanted to do. So they've just kind of like said, all right, we're just going to bury this in the economics and either not do business with certain people or just work around it. But now, for me, when I hear people say like, hey, wholesale is in a position where potentially, if their prepayment speeds are faster than other industries or other channels, that their pricing from Ginnie, Fannie, and Freddie could be negatively impaired. Well, that's when I have to, as a leader of brokers, I have to say, okay, let's take a step back. Let's identify the speeders. Let's identify the people that are the have the bad practice. Number one, how do we slow it down? So for me, it's a communication thing. Me reaching out to them and saying, hey guys, this is what's going on. Here's the impact it has on the channel. Usually when that happens, and I've done this on several issues, compliance related, those people break into two buckets. One bucket is the people that are, oh, I didn't know. And even though this is their business model, they didn't know the negative impacts it has on the end user because nobody explained it to them. And those are people we can work with. Then there's another group that says basically, I don't care, and that's it. And those are the bad actors. And those are the bad actors that, to me, everybody's got to know they're bad actors, and everybody's got to put them in the penalty box with the way they price them or their EPO policies or whatever. So going forward, though, the biggest thing is transparency, full understanding of what's going on, because right now the truth is of the people that are being put in the penalty box with a 12-month EPO, most of those guys didn't know, and corrective action behavior will happen. But for me, that excuse will no longer be an excuse going forward, because the level of transparency and information that I'm going to make sure is out there around these subjects is going to be, it's going to be there. So there's nobody can say, oh, I didn't know. Just like, wholesale lending, brokers would say, oh, I didn't know that Freedom or Quicken or whatever lender went after my past customers. Well, now it's out there. So if you do a loan with certain lenders, and I guess for you, when you see what's happening, what would be your biggest piece of advice for an LO that says, hey, Mr. LO, I want to be doing this for 10 years, and you like to say brokers are better because brokers have better pricing and brokers have, better whatever. Well, here's how this subject can negatively impact you if this continues.
Yeah, I mean, if you think about the broker model, which I'm a huge fan of, but as you know, I'm a huge fan of multiple channels. I think having healthy, viable multiple channels in the mortgage industry is very important. I think anytime you get overly concentrated in one channel or another, it's bad for consumers, it's bad for the industry. So I think there definitely needs to be a balance. But you hit on the head when you said, as a loan officer, as an independent mortgage broker, as an independent mortgage loan officer, or just as a loan officer in any channel, in any company, we all hope that you're just not here for the quick win, right? We hope that you're here as a career. And having a business model that is sustainable in all kind of economic environments is critical for that sustainability. And so chasing, having a model that is a serial churning model is not sustainable. It ultimately will catch up. And Anthony, I think you're having this conversation and putting it out in the Facebook groups, putting it out on LinkedIn, you're helping educate the frontline loan officer. But I think what you're also going to see is you're helping the wholesale community and the investor, the correspondent investor community, have those tougher conversations with their clients, right? You've kind of put this out there. You've had some of us come on and talk about it, and now it's okay. It should help those account executives have these tough conversations. And I would say to the account executives, go talk to your customers and relay the message that we're talking about here today, but bring it to them in the perspective of your company and your own business model, and why having a good partnership and having these open, honest conversations is important. I think this is all going to have just a positive effect on those relationships. And will there be some defectors and some originators, brokers, correspondents who say, well, I'm just going to go over here and sell to this guy because they're not enforcing this? Yes, that's going to happen. But that's also going to be a short-lived situation.
Yeah, so that's a good point, because I think you're right. I think right now, hopefully, this does allow those conversations to happen. But I think the thing that scared me when it was this whole concept was explained to me, and how Ginnie Mae and Fannie and Freddie were viewing it, was that because nobody was having those hard conversations, the way that it would play out is it would just simply be one day the rate sheet that we were getting from our wholesale lenders would just have another adjustment. And basically the adjustment would be built into that base price, where all of a sudden, where we used to have, hey, you could make full underpaid and be 0.25% lower in rate from your competition in retail, or 0.5% on government, all of a sudden that spread would go in half, or potentially be leveled up. So for me, that's brokers don't know, and because nobody's talking about it, they wouldn't know till it's too late. And for me, it's, now's the time to take immediate action and understand that yes, rates are very low right now. There's a refi opportunity, but what we need to assess is, guys, when is the appropriate time to have the conversation? So 6 months ago, you might have been talking to a customer that at that time it would have been a little win, or maybe the customer would benefit slightly from a refi. Well, 6 months later, now here, it's a big win if you waited another 6 months. Except now you have costs for 2 transactions that need to be retired, and the way people that do this retire that cost is in the interest rate by getting a lender credit. So I think at the end of the day, if we want to consider ourselves advisors, and we want to consider ourselves the best agent for the consumer, we really have to take a long-term view on these things. And we need to understand that the benefit isn't zero cost loans, and the benefit isn't break-even point. It's what is going to deliver the highest value to the consumer over the life of the loan, and not bearing it in their interest rate.
Yeah, something that came to mind as we were just talking, I think about, and you hit it on the head in terms of waking up one day and the rate sheet's different, right? And by the way, the rate sheet could be different by wholesale, by broker, right? So in a particular wholesale lender's pricing mechanism, there could be different factors that go into a rate sheet price for a segment of brokers versus another segment of brokers. And the best way to describe that for a loan officer or a broker or anybody that's kind of runs a secondary market desk or builds their own pricing is when, as an originator, as a broker, you have 15 relationships that you have approved and active with. You may have a PITA factor in a particular relationship, right? The pain in the ass factor. And you may have, your pricing markup for that lender is 50 basis points because they're just tougher to deal with. Well, that same situation happens the other way around at the wholesale lending shops and the correspondent shops. There's cost factors for relationships, and part of that is the thing that we're talking about now, which is the speed factor. So it kind of cuts both ways, and that's just important. I think that's a good analogy to kind of think of as a loan officer, is if you artificially price a wholesale lender higher than others because of their hassle factor, know that can also happen to you based on economic factors, including how many times I could touch your loans or how fast your loans prepay.
Right. And at this point, I think the other thing is that there is a level of transparency that's coming to the market in the last 2 years between CoreLogic data, just all the different data sets that are now available. There's no hiding anymore. Okay. Like there used to be a time, I remember there was a point where, a wholesale lender could go into a broker shop and say, oh, what's your volume? And a broker could literally say, I'm doing double the volume that I'm really doing, because there's no transparency in the data. Right. And every single lender knows what the volume is that every LO and broker's doing. They know purchase refi. They know, what are the rates you're giving them? Is it Fannie? Is it Freddie? Is it Ginnie? They know everything about what you're doing, who the lenders are that you're working with. So there's full transparency. So, understand that as the data sets come out every quarter, and the same names for the same consumers are on your pipeline list, and over again, one loan officer has the same customer on their list over a 24-month period of time, 3, 4, 5 times, that's not going to be something. First of all, lenders now can forecast that they don't want to do business with you, meaning when you fill out your broker package and they look back at your 12-month data set and they're like, hey, this one LO, he's redoing 25% of his clients 3 to 4 times. Guess what? They're going to make sure they price you specifically at a rate sheet that doesn't allow you to do that, and maybe even put caps on your rate sheet so you can't price them as
or don't accept loans. Period. From
or just not do loans with you. And the reality is, again, we talk about partnership, and we'll end on this: is you have to understand that it is a partnership. If our wholesale lenders go out of business, not good for us. Above and beyond that, if Fannie Freddie are being hurt by us, not good for us. So, like, in order for everybody to operate optimally, we have to be considerate of all the participants.
Yeah, I would just add, because it feels like we're picking on originators here, and I don't. That's not the purpose here. Just to kind of level set, I don't think this is not just a loan officer issue. This is kind of one of those point in time issues that our industry has to come to grips with from a technology perspective, right? And how I'm on that side of the equation, so I got to be careful here. But from a technology perspective, there are so many more tools now available for the consumer that they have access to, right? So, and so social media, just general media, technology tools, bank rate, and all these places where consumers now have visibility into what's going on with rates. So there's that. So that doesn't really have anything to do with a loan officer. And then just our ability from a technology perspective to be quicker. We're still not quick enough in processing and closing loans, but we're getting more technology at the point of sale to do that. I think as an industry, the evolution of how we value assets, in particular MSRs, will start to change dramatically because of how quick it will be. You'll be able to process or get a consumer from point of interest to point of closing on a refinance transaction. So all that stuff's kind of happening at the same time. So it's not just about the originator. So we just got to be careful to recognize that this is a bigger issue. It
is. All participants are involved, and I think for us as brokers, we are originators. So like our role, whether you're a brokerage or an LO, you're an originator. And for me, the biggest thing is we just need to, as a whole, understand that if we're doing something, there's probably another 100 people out there or X amount of people out there doing the same thing. So if you quantify something that's a bad behavior or a bad practice by that measure, it can really get dicey quick. And it can be very bad for a lot of people. So more than anything, this wasn't, my goal in sitting down again is bringing the information to the market, making everybody understand the why. And for right now, this week was UWM that had, identified 100 brokers. And in another couple of weeks, it's going to be other lenders. But
they're not going to be the only one. Trust me.
They won't be the only one. And what I really want the loan officers and brokers to understand is, again, 2 buckets. There's people that get the information, they're going to learn, and they're going to change going forward. And no matter what, those people are AIM members, and we have their back, and we're going to support them. But if there are bad actors, what we're not going to let happen is we're not going to let a group of people negatively impact the entire wholesale channel and all the brokers that do it the right way. So we have to have, that kind of mindset is we have to look out for everybody.
I 100% agree. And I applaud, UWM. They've done a great job growing their business and in conjunction helping grow the broker channel. And so for them to kind of take a leadership role in this issue is actually great for all of the entire industry.
Yeah, and hopefully, I think brokers are going to respond very well, and I expect this to be a big learning opportunity. So we've been on for a nice little bit here. I appreciate you hopping on a Friday. This was a kind of a last minute request. So Brian Vieaux is from Finlocker. He just launched a really big initiative with Vetted VA to enable members of the Vetted VA community, loan officers, mortgage brokers, to basically provide the Finlocker vehicle to veterans that are interested in purchasing a home.
Yeah, it's been cool to watch. Chris Griffith and Nathan over there have done a great job with that group. I love watching what they're doing, the advice and interaction they're having with the veteran community, and get to play a really small part, and we're honored to do that.
I'm looking forward to it as well, because I think it's the right group, the right community. It's the right group of people in the Vet VA, LOs and brokers. And obviously, we're big fans of Finlocker, and we're looking forward to it being a big part of what AIM does moving forward as well.
Awesome. Well, thanks for having me on. If you'd given me more notice, I would have wore a suit and tie, but you know me better than that.
No, you're fine. I appreciate it. We'll talk very soon.
Have a great day, everybody.
Have a great day.